Hello and welcome everyone to the the weekly Delphian meeting. Thank you for tuning in. So today we're going to go through our usual market update. I'll answer any questions about the earnings plan. There's a few new trades out there, and then Joe's going to talk for a little bit. I think he had a few things to bring up. So that's the agenda today. So let's get started. All right. So overall for the market, you can see everything's still in state 8. We did do a new addition here. I'll annotate it. Our programmers up in the top right there were able to complete that. So basically what this does, it shows you the pie from a week ago to the current day. And we also changed all the percentages we're showing here. Still little tweaks to do, but we figured to push that out to everyone. I think it's very useful, for that trend, the 1 week trend overall. So you can see here, we're 22%, we dropped 10% in a week. Huge number of state 8s here, 70%, pretty crazy. So we'll go through the market pulse and then also look at the major indices here. So as you can see, this is state 8 and state 1s. You can see, we've made new highs for the number in state 8. We got up around 65 here. So we popped up to 70 here. Huge move down over the past couple of weeks. And, it looks like the market's finding a little bit of a temporary floor, but we'll have to see. We are definitely in the oversold. We were oversold last week, still oversold even more. 30%, under 30% is oversold. So let's take a look also at the new lows. See, we had good spikes here. It didn't really start happening until after some major movement down there. But we had 2 peaks. We're back down to a normal-ish level. But as we've been talking about for a long time, I don't know why that's both are red. Yeah, that's weird. That just popped up. So the contrast isn't really helping with anything. But you can see, since November, we're just getting spikes in the lows with, little lull periods here. And that's just continuing on as the market kind of grinds lower. It's not, we're getting some big sell-off days, but, it's pretty much grinding lower. And that's, as we've talked about a lot, that's driven by the Fed and what they're doing. I mean, they're reducing the balance sheet and raising interest rates. That's just going to drive markets lower, until they reverse. I don't think much is going to change. So, that just bothers me. Anyway, so let's look at bullish bearish. So, we got close here, that run up, basically reversed. We're up 87%. So that's about where the high was last time. So just something to be wary of. Obviously, we stayed up at those kind of levels for a while before turning around. But obviously, very oversold conditions. So let's take a look at the modeling. The last week, one of the key things I pointed out was this target 3 level. So you can see that held, at least temporarily, that 36.72. We can see over here, this is the move within the state. We barely got below it, but that's providing pretty good support. Tested it 2 days there. So obviously that's going to be a key area to watch on the downside, 36.72. Obviously on the upside is going to be our 3,800. So pretty narrow range to watch right now. As far as the modeling, and this is from our charts at 3,800. SPX, it's trying to get up to that 3,800. Let me pull up the current price. Sorry. So we're only about 24 points away. So that's definitely something you want to keep your eye on. So really, it's if we can get above that 38, hold there for a few days, and I'd say we can move back up to the higher range, which is 4,200 to 3,800. But they're having problems, both indices, Russell and SPX, getting above these critical levels. I'd say right now we're in that 3,800 to 3,400 range. Just based on how long we've been below this 3,800. So so that's our current range right now, 3,800, 3,400. But just keep a close eye on that 38. If the Fed starts doing something positive for the market, that could, we could see a good rally, if the Fed starts doing something positive. But as long as they continue, I would say that 3,800 would be pretty tough to break, and just expect us to be in that 38 to 3,400 range. Let's look at the big chart. You can see here's our ranges now. Let's see, 38, 3,800, and 34. So that's current range. If it does break and hold above that, then this would be the range up here, the 42 to 38, which we were in previously until we broke down here. So one of the other things just kind of point out is in like bearish markets, these moving averages provide pretty strong resistance. So you can see we have quite a few instances where things were tested. Obviously it broke above here, but then back here, and then this whole period right here. So the 50 is acting pretty good. Judge of resistance, it's well above our range. So it'd be in the middle of that 42 to 38, the next level above. It's pretty much right in the middle of that. So nothing really to watch currently on that. I would just say really just want to watch 3,800, and then this 36.72. We can get below that and hold below there. That'll be pretty bad for the market. So I'd expect 3,400 to get tested if we can hold below there. So as usual, we're right near kind of critical levels. Let's look at the Russell here. So obviously doing a nice standard kind of move here. Where we go in here, kind of pull back, hit the average, and then chooses 1 to 2 pass. Typically it'll rebound, but markets, that's based off of historical data. So on average, 90%. Well, that don't really tell you much. It's going to go to state 7 eventually, but I think the bigger thing is with the modeling, this SPX, it's been in state 8. So when it goes, eventually into state 7, does it go back into state 8, kind of like this one has been doing. So, this one definitely has been leading the way down, which is, I think, kind of critical to watch. I'd expect bottoms to be made in the Russell and, like XLC, which is also kind of led the way down. I'd kind of watch those for bottoming type patterns. Yeah, but this one's doing 8.7, 8.7, 8. I mean, this last 8's been pretty ugly so far. So, we'd expect this to at least, do like the average move, which is down 10%, which, the range that we have on the charts are pretty well aligned here. So we have 1,700 and then, 1,500 are the current ranges on the Russell. So, obviously, the critical other things to watch, if we do get down there are, the T3 is another big one to watch. So really it's just, can we get above 1,700 currently? Right now we're right below it. We're about right below it. So we're close on both of them. So it's something really to keep your eye on, if we can get above those levels. So also here, same thing, 17, 1900, draw those lines real quick. There's the 19, there's 17. I didn't do the Fibonacci ones. It's kind of messy. This is, we know the levels. I don't have to do it every time for you guys. So, critical to watch this. We've been down below 1,700 3 days here. We'll have to see if this is going to be strong resistance or not. It's testing it. I think yesterday, it barely got above 1,700. Yeah, 1,711. But closed well below. So that's what I'd watch for on the two indices here. One other thing we wanted to pull up. Was it, Joe, was it the XLC chart we were looking at?
It was, Josh.
Okay, I'll pull that up real quick. I'll pull that up. Obviously Fed always, want to cover this. So this is for July. Obviously, right now, pretty much priced in for 75. I think the next one, September, is priced in at 50 currently. So kind of more swayed toward 50. This would be 75. So we still got a month until this, and then quite a while until that September one. So it's a nice break after the July one. Get a couple months. So nothing really changing on this front from last week, but always interesting to watch. So, XLC, obviously you can see this one's 8787. I think we didn't do all. Kind of want to pull up. I think we were doing something like this, something that basically, we got a nice solid downtrend line here. Where it's basically bouncing off. So that, I think this, because I'm kind of keying on this one since it's really led the market down, started turning over in September, well before the major indices. I think Russell was like what, November timeframe. So I think this one, would be something to watch. But you can see that's a pretty strong support on the way down. So I just thought it was interesting. Wanted to pop that out there for everyone. What else do we have? 10-year action has been pretty crazy. I mean, really crazy. It's almost like it's unhinging the amount of moves. I mean, typically this thing does not move like this. We had talked a lot about June being interesting. I don't think it's disappointed at all. I think it's just going to get more and more volatility going forward, craziness. I heard things like ECB's doing like extraordinary measures, whatever that means. So I'm not exactly sure, but I'm trying to find out. You know, the if the banks step in, the federal bank, reserve banks step into, you know, really help stabilize like the debt market, then I think that's going to be a bullish sign overall. You know, any kind of thing like that. I'm not sure if they're doing it yet. I think at some point they're going to. My guess would be, you know, when things get uglier, like late summer type thing. But right now, I mean, just the action on this, I mean, you know, we went from 3.1 all the way up to, you know, the high was like 3.5, down to like 3.15, just in what, you know, 2 weeks. I mean, just crazy action for something that normally does not move like this. So definitely something, you know, it's higher than when we went back. Let me pull back here. This is 2018. We got up to like 3.24 or something like that, like 3.25, call it. So we got higher than those levels. You know, and you know, the market obviously did not react well until, you know, the Fed reversed action. So we're higher than that. You know, let's still kind of stick by that. You know, over 4 is going to be real ugly for the markets. But obviously it's still pretty ugly right now. You know, and we're just pretty much right at those rates now, although we did spike higher and came right back down. I'm not sure what would drive that recent move, you know, where, yeah, we got up to like, you know, 3.5 something. I have no idea why, you know, we'd pull back here unless, you know, I don't know who's who's buying debt, you know, who's buying 3% 10-year debt when inflation's like 10%. Not sure who's doing that. So doesn't make sense to me for people. I would expect those to go higher. But, you know, day to day, hard to say what's really driving the markets on that. You know, the Fed supposedly should be running assets off the balance sheet and not buying more. So if there's no bid, I'm not sure who's buying that. This, you know, there's a lot of recession talk. You had a negative read on GDP last quarter. I heard, you know, like the Feds, the Atlanta Feds, like was basically at a 0% for this quarter as of the last Fed meeting. I heard that somewhere. So we could technically be in recession. You know, the definition of that is 2 negative GDPs quarters in a row. So we could technically be in a recession. So that may be driving people to debt. Not sure. So I think that's it. I did want to throw in a quick pitch. We sent out an email. Ashok's going to be on this Trade Options Summit with CBOE. He's on at 3:30. We sent out an email to everyone. So if you didn't get that, just, you know, message me. I'll forward it to you. But he'll be on today at 3:30. It's like a panel. So in case you're interested. I think that's about it. A little slower week than last week as far as news and stuff like that. So I'll open up to questions, comments.
Hey, Josh, it's Lee.
Hey, Lee.
Hey, when I watch the analysts on TV, they now seem to be switching from a 50-day moving average to a 50-week. And they kind of almost laugh about it, but that they've switched. What's the implication there? What are we saying when we look at normally I think of a 20-day or 21-day and a 50-day. Now they're
Yeah.
going 50-week. What's that telling us?
I'm not sure why they would be doing that. I've never, I mean, that's a long term.
Yeah,
50 weeks, basically like a year, right?
yeah.
52 weeks in a year, so it's like a 1 year. So, if you had I mean, it's almost like a 200, it'd be 230 or something. I don't know, as far as the moving average day. Not sure.
Okay.
I've never used it that long term. I think 200's plenty of distance. It barely moves, so I'm not sure. I prefer, I think that's more of like a benchmark. Um, you know, obviously when it gets below that 200, there's more risk in the market, right? And when it's
Uh-huh.
providing support, it's still, like bullish type thing. I just key on the 50-day more to see, if that's providing, support and resistance. Really, I mean, it's not like it's just kind of like a nice, like, not even secondary, kind of like a third, tertiary kind of indicator. Sometimes it'll be real strong, so then it'll kind of take focus. But if it's not acting super strong, then like Russell, it's like the 50 days pretty good resistance right now. So after it's been tested a few times, but we watched like the SPX, like that 50-day was really strong on the way up for a long time. So if it's acting like strong support and resistance, then I give more credence. But if not, then it's just kind of like, well, just check it. But I have no idea about 50 week. I mean, that's really long. So.
All right. Thank you very much.
Josh,
Sure.
I get this job. Nothing really to add on that. It's six, you talk about using the 50 as, a support and resistance level. And I think it just adds another layer of that. Obviously it's a much, slower moving number and, potentially is another support or resistance line, but nothing else.
Mm-hmm. Yeah.
Thanks, Jeff.
Right. Yeah. Thanks, Lee.
Sure, Lee.
Josh,
Right.
this is Dave. I got
Hey, Dave.
a comment or two. By the way, I've been out for about 6 weeks on a visiting daughters and grandchildren tour through
Oh,
many
nice.
states. Through many states. So I wanted to say just a couple things about that I thought was interesting. I was watching gas prices. I think I left in early May and I got back like last week. So
Yeah.
traveled through Florida, Louisiana, Alabama, Texas, New Mexico, Utah,
Good Lord.
Denver, and I came back about on I-40 across going up through Wisconsin. So one thing I noticed, though, a couple of observations I just thought was interesting.
Yeah.
I noticed that gasoline prices in the red states was significantly cheaper than gasoline in the blue states.
Mm-hmm.
And Illinois was almost $1 more expensive than the cheapest price that I
Yeah.
had. I can't remember exactly where that was, but I just thought that was kind of interesting. The other point I wanted to make was going back. I think I don't know how long ago, but I remember talking about a longer. I was putting up an SPX, or I asked you to put up an SPX chart that was like 10 years, or back to 2008, to try and get a trend, an SPX trend up until the pandemic, then after the pandemic. And I was just re-looking at my chart just this morning, and it was like, we've come right back down to where that. I wish I could show it to you right now. Maybe I'll take a picture and send it out to everybody tonight. We're kind of right back on the trend line that we established. If you kind of go from 2008 up to the beginning of the pandemic, we've kind of come down to where that line, my trend line, was drawn, which is, we're kind of. I'm not sure. I have a question for the group. I'm not sure where.
I can't hear you, Dave.
Does anybody remember what the interest rate was before they dropped it to 0 in March of 2020. Does anybody remember what the Fed funds rate was back then before they dropped it to 0? I don't know either, but okay.
No.
My question to myself was, okay, if we've come down back to where the trend was before the pandemic, are we getting most of the pandemic issues through, through the, market pricing mechanism, whatever that is? And so I would say, well, maybe we're back to where we should be. Now, my question is, the trend line that was 10 years was over a time period where interest rates were very low and kept low. And now the Fed is raising rates. So even though we've kind of come back to what I would call maybe where we should be as far as like a growth, without any issues where growth would have taken us, if we're now going to be in a negative interest rate environment for a while, will we overshoot or undershoot where, the trend line and go below it? So that's kind of where my questioning or my analysis will be, with the Fed raising rates, how is it going to impact inflation enough while they're raising rates? And like you just said, we're going to have a GDP print pretty soon. I'm almost rooting for a recession so that we can get that out of the way, so to speak. And people say, okay, well, we had the recession, we had a big bear market here. It's time to resume to growth. But that's the question. Will we be able to resume to growth just because we technically got someplace on a chart over a certain period of time, but growth is going to be stymied because of where interest rates are going? That's the question I have for probably a month or two to come. So I don't know what other people are thinking, but yeah, I look for kind of a rocky road yet. Where VIX is at 30, it's come down to 30 from the past week or so, and that's still way too high. And there's no new negative news, like you said. So VIX being higher now, incrementally higher with the same negative news that we've had for months, doesn't bode well in my mind for where we are, where we're going in the near term. Now, I don't want to be a doomsday issue. I don't think we're going to have a doomsday, but it would be nice to get the recession thing out of the way, and for the Fed to realize where they have to have a topping out, with the interest rate thing. Yeah. I don't think they're going to raise them just so they can drop them in September. That would be kind of weird, but some people are even saying that. Well, they're going to raise them 2 or 3 times so they can then drop them in Q4.
Well, I mean, 18, they did that. They like, oh, we're going to go back to normal. And then it's like, oh, wait, we can't. It'll implode the economy.
Right. I was wondering where we were just when the pandemic started, because I would say maybe that's where target rate should be, but I don't know what that was. So
yeah, I don't remember offhand.
I just looked it up. We were at 1.5 and we're back at 1.5.
So we're still, okay, thanks for that.
Yeah.
That's all I wanted to say there, but it'll be an interesting quarter coming up.
Now, one of the things before the pandemic, there was not this rampant inflation.
Right.
So that is a different condition, but looking at the historical Fed funds rate, it was in February of 2020 was 1.5, and now we're back at 1.5.
Interesting.
Yeah, interesting. Yeah, we're almost getting close to the pre-pandemic high there, like 33,385. Let's call it 3,400. Oh, we're getting high there. Yeah, I'm not sure about. I think it's a lot of unknown. But obviously, you got to take the Fed at their word right now. Their number one goal is combat inflation. So I wouldn't expect unless things get real ugly for them to deviate from that, raising rates. I don't know what it will take to turn back this inflation, honestly. I think, a recession could help, honestly, with the inflation, but I don't know. They keep raising rates. I mean, it's going to be a problem for companies too. I mean, like operational capital, like everything's just going to cost more and more. The more they raise the rates. I mean, we're used to like these, 1%, loans, or, people had 3% on their houses or lower. Everything's just going to cost more the more the debt costs. I mean, we're a debt-driven economy, so the more they raise the rates, the more expensive it is for everyone, to operate or borrow money, which a ton of companies do.
I heard even more concerning comments by Mohammed Al-Arian and Dan Niles on CNBC. One of the things that raising rates does is makes the dollar stronger and against other currencies. And other countries are having this inflation problem too. This inflation thing is not unique to the US, it's
Right.
worldwide problem. And so now you have these other countries who want to raise rates to battle inflation, but also to defend their currency, right? So you mentioned earlier that ECB is looking at raising rates, and they've been negative, right?
Yeah.
And I don't understand why. We never went negative. And I heard Dan Niles comment that the Swiss National Bank, which is the Federal Reserve of Switzerland, they have been over the past decade buying tons of U.S. stocks, and now in order to defend their currency, they're saying they might sell all those stocks. They're one of the largest holders of Apple, for example, things like that.
Yeah.
So as these other federal central banks start implementing, you could get into this spiral of central banks defending their currency, fighting inflation, all of which are tightening policies that are bad for stocks.
Right. Yeah, I agree. I mean, the big, red flag you want to look for is liquidity problems, because at that point, with the banks, the overnight lending rates, things like that, you start seeing liquidity in the headlines. I mean, that's where things get real ugly. People just, sell all market order type thing, but I mean, the rates going higher and higher. I think that's what it's going to be driven to. We're going to start seeing more of that.
We got an interday Wall Street Journal headline about an hour ago from Powell, basically conceding to the fact that the rate rises may lead to recession. So, he's, I guess, at least coming out publicly and saying that it's a distinct possibility. I think that's a little different, his acknowledgement of that.
Yeah. Well, I would guess we're probably already in one.
Yeah, I think we are. And also, I mean, I think they're trapped. In the past, the past times they tried to raise rates, they could drop rates because we didn't have this big inflation problem.
Mm-hmm.
And now this inflation problem, it's worldwide, it's persistent. I just think they're trapped. I don't think they can. I think they have to keep fighting.
Yeah.
I think they can do.
Yeah, I agree with Sadir 100% on that. They were trapped. And one other observation I noticed lately, we had all this rapid rise to inflation, right? Because here's my thing, why? Because every company thought, well, okay, we're coming out of the pandemic now. We have all these vaccines. We're not going to go down to any lockdown. We're opening up. Everybody's going to open. So everybody tried to raise prices and thought they had pricing power, right? Everybody did. Certain monopolies had more pricing power than others. That's why gasoline and food prices are still sticky. But I noticed at grocery stores, for example, now I see a lot more BOGOs where buy two, get two free for, bread, milk, not milk, soda pop, things like that. So that's telling me that actually there's been some demand destruction in certain brands who thought they had pricing power. They're turning out, well, maybe we don't. So I guess we'll have to like clear inventory now. Maybe we'll drop our prices. So I really think that's what the Fed thought way back when they thought inflation was transitory, that demand destruction would just take effect real quick and be over with, but it didn't. They totally miscalculated on that. But
Yeah.
I see some pricing power or some demand destruction out there already. So I think that's kind of a good thing. It's good to see some prices coming down.
Yeah. Well, it's definitely nice to see crude oil retreat some here. I think that's one of the main drivers. I mean, everything's driven off of crude oil, right? I mean, everything at the store gets there via truck, right? So I think that's one of the key drivers. I think one of the other things, after the pandemic, I think just, a lot of supply chain stuff got broke, and, China's really not helping. They locked down 40 million people when they're supposed to be making goods to deliver here. And like all the shipping problems that had, just the logistics just went to hell. So I think that those are kind of the two main drivers: high crude oil and supply issues.
I think also as we start to get into the height of earnings season, and we're still a little ways from that, but I think probably on a daily basis, especially the big names, those companies that offer forward looks with insight, I think will move the markets. And we're a couple weeks away probably from the bulk of earnings announcements. Yeah, it's probably a solid month, but I think that's going to be a market mover too, big time.
Yeah. Well, I saw like the Target CEO said he's never experienced an environment like this. So not a good
I don't think
thing.
anybody has,
Yeah.
honestly. I mean, a bunch of us, I'm sure on the call, certainly remember high rates. Maybe not you, Josh, as young as you are, but, back in the 70s. But, certainly traders, most traders, it's been a generation and a half since there's been anything like this, if there ever has been. And so it's a new frontier for everybody, which, is certainly just going to add to volatility.
Yeah. Yeah. Continued volatility expected. So. All right, good comments. Anyone else got questions, comments? Just wanted to show real quick, we had two, the earnings plan is out. They haven't fixed the plan, so I did it like this. I don't know if I can post this to the share drive. It's just basically, it doesn't update, but it's just like a snapshot at the beginning of everything in like chronological trade date order. So this is what I'm using to track. So we've had, like 3 trades so far. This one came out this morning, bullish pre-runner for JPM, and then Travelers the day before. So I'm tracking all these now. I think Travelers up a little bit. JP pretty much flat from the morning, but obviously if you're trading those, obviously keep an eye on the markets, and if you are trading those, I think if we get above those kind of key levels, then we could have a nice little run back into the middle of the upper ranges, but I think it's going to be tough to break above those levels. So, but those trades came out. Let me in the pre-alerts.
Hey, I have a question.
Yeah.
Does anyone know what core PCE price index is?
Core what?
PCE, Paul Charlie Edward.
I don't.
it's a report coming out next on the 30th that is supposed to be key. I mean, I know what CPI is. I don't, and the producer price index, what is PCE?
Not sure. I'd have
Anyway,
to-
it's a price
I'd have
index.
to Google it.
Yeah, it's a price index coming out on the 30th. And remember how the market reacted the last time the CPI came out.
Yeah, yeah, yeah.
So if this is bad, watch for something on the 30th would be the next big thing.
Yeah, any inflation readouts, expect volatility. Could probably even play straddles on those days or something, you know. Yeah, so here's the two trades. I'll update next week on how they're doing, but yeah, they just started, so. But we'll do that each week, just track all the trades, go through and show you them in the portfolio, just give you kind of running tab. I think it's always good to keep tabs on the, you know, studies and, you know, earnings trades to see how they're performing, and, you know, keeping an eye on the, you know, the green pie, whether it's getting bigger or shorter. So that's a good help. So. Is there any other?
One thing, just one thing I would add there. So I think everybody may realize, I mean, there are close to the 6,000 issues that are listed with options. Our liquid list is only about 350, and that's what we base the earnings plan off of. So it's a small universe of stocks. You know, we go through, you know, different filters to make sure that, you know, there's decent liquidity and other factors. But just everybody, if you have, you know, favorite stocks that maybe you don't see come up in the earnings plan that you'd like included, at a minimum, you know, please send it to Josh or I, and at a minimum, you know, we'll run it through our filters and see whether it fits the criteria. And if so, you know, we'll add it to the plan next quarter.
Yeah.
There is one that is not in the system that I mentioned before, which I think, you know, it's a giant stock, and that's Berkshire B. It's not.
Yeah.
In, you know, I don't know if it meets any of the earnings criterias, but it's a pretty big stock, and I would recommend adding it to Delphian.
Yeah, we're going through, you know, we have CBOE data with 6,000 stocks. So we have all that data now. So we're going through the actual list of what to include and what not to, and what to exclude. But it's definitely in there. I've seen it.
Yeah, you can do options on Berkshire.
Yeah, so that'll be in there. And like, once we get through all this, we'll go through and do a new like liquid list too. So, but that's kind of what we're working on. We have all the data now from 07 for all those symbols. So yeah, we'll add,
Josh,
that'll get added in the near future. Yeah.
It will indeed, and that is one of the heavy lifts we're doing behind the scenes, is just to integrate the SIBO data. And we'll get there and let you know when it's all in place.
Thank you.
Okay. I don't think Joe text chatted. He said personal, what was it, Joe?
What was that,
PCE,
Josh?
personal consumption expenditures,
Oh.
PCE.
Okay.
That's what Dave Russ chatted out there. So,
Well, as much as inflation is being watched, this is the next report that will indicate if it's going up or down. I think the market will react. It's June 30th is this report.
okay, so we get a week.
Correct.
Yeah. Okay. All right. Anyone else? Joe, did you want to go through anything?
No, I think I just touched on a couple of things earlier. I did send out, as you pointed out, you know, Shook's on at 3:30 today on the Tradier SIBO event. So, you know, if anybody has time, check them out. Nothing else.
Okay. Yeah, I don't think we had the bottom on this one. I think it was XLC. Maybe this one. Let me check real quick. There we go. SPX. I don't think the Russell had it.
Yeah.
Yeah,
You're right.
so,
Not a bad line.
no,
And
pretty,
descending triangle potentially, you know, from the March highs.
yeah,
Yeah, I would actually draw from the March highs.
oh, okay. I don't know how to clear it. I just have to clear the whole thing. That. And that,
There you go.
yeah, it's a good, Joe pointed that out. I thought it was worth at least looking at, for, support levels. So, well, acting pretty good so far. So something to keep an eye on too. Yeah, I think it's around 3,600, so. Okay, well, we'll close it up. Anyone got anything else? Questions, comments? All right, well, thank you all. We'll do it again next week. Thanks for tuning in.
Thank
Have a
you.
good week, everybody.
Thanks, Josh.
Thanks, Josh.